Enphase is down 40% in the past year. They are reporting earnings next week, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Google Sheet to calculate the intrinsic value of the company. Starting with the financials, Enphase revenue saw massive growth from 2019 to 2023. However, it has been decreasing a lot in the past year, going from $2.7 billion to $1.8 billion currently. Their profit, similarly to revenue, jumped from 2019 to 2023, net income going from $10 million to $572, and then decreased to $275 currently. And free cash flow going from $34 million to $865 million and then dropping to $404. These declines are due to a significant drop in demand in their key US market, which was influenced by seasonal factors and a broader economic slowdown that impacted consumer spending. Analysts are expecting them to come back and reach $3.7 billion of revenue in 2028 and make $9.50 per share. If you assign a 20p to the company then, it would make it a $190 stock, meaning 71% returns. And even though the revenue has decreased in the US, it grew by 70% in Europe. And their gross margin has also been increasing despite revenue decrease. Then, in order to calculate the intrinsic value of the company, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. Right now, you're seeing 6 numbers. The top 3 are based on net income and the bottom 3 on free cash flow. They mean 2 things. First, in order to make the desired annual return that I have put in, which is 12%, you need to pay these prices. I went with 12% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. Second, the stock is currently trading at $108 per share. Therefore, if the low assumptions occur, you're going to make a 2% annual return on your money, middle 12%, and high 21% based on free cash flow. Based on net income, they would be a bit lower. I believe my assumptions are reasonable as I have the company growing revenue at 10% annually for the next 7 years on my middle assumptions, 15% on the middle and 20% on the high, averaging a profit margin between 18 and 28% for the next 7 years and a free cash flow margin between 20 and 30%, which is what they have been doing for the past 5 years. And their profit margin is a bit lower, and that's why I went a bit lower on profit margin. I also assigned an 18, 20, and 22 PE and price to free cash flow to the company at the end of the 7 years and left the share outstanding change at 0%. They are also selling at a PE of 57, a price to free cash flow of 37, and a price to sales of 8. And therefore, we can conclude that the company seems a bit expensive. But they have a great balance sheet, as they have $1.6 billion in cash and only 1.3 in debt, which is very little for a company that has a market cap of $15 billion. I used to own this stock, and I eventually sold it for a 38% gain, luckily, but the reason I sold was because I wasn't sure about the future revenue growth of this company. In conclusion, I believe that this company could have a lot of upside potential, as they are in a sector with a lot of future growth. And if you believe the demand problems are temporary, this could be a great investment. Remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about Enphase in the comments and I'll see you in the next one.